Chapter 1: The Environment and the Theoretical Structure of Financial Accounting. In this chapter, we focus on two primary topics. One is the environment of financial accounting. Basically, we will answer what is accounting and why accounting, why we need accounting in our world, right, in our society. Next is the theoretical framework of financial accounting, okay, which provides theoretical foundation for accounting. This chapter is kind of boring to most people because you will be introduced a lot of new concepts and terminologies you may never heard about. Okay, the fun part of financial accounting will be introduced in the following chapters. But this is very important. We will also refer to the content of chapter 1 later. Okay, first let me introduce the role of accounting in our society. Okay, in a simple word, accounting basically provides information. Okay, our product is information, and the information is used for decision makings, right? And we know our society is composed by peoples and business entities and non-profit organizations, right? We all have different transactions, billions of transactions every day between people, between entities, between entity and peoples. And so how to record these transactions and turn them into useful information is the role of accounting. This figure shows us the role of accounting in our world, particularly financial accounting. We know there's a lot of business activities going on every day, right? And accounting is to convert these business activities or economic activities into useful information. Okay, so the role of accounting, I use the red circle. Inside the red circle is the role of accounting. Okay, basically we convert unorganized and scattered economic activities into useful information. And this information will be used by different people to make decisions. And this decision will affect their capital allocation. Okay, for example, the shareholders may prefer to allocate their money, their fund, to the most profitable companies, right? But how you learn whether a company is profitable or not? Financial statements. Each of us also provide capital in our society, our human capital. So I believe everybody want to work for an entity that provide you, reliable and high compensation and benefits, right? Yeah, so you may base down the decision on the reputation of the company, but you should also check their financial performance. And these information are only available in the financial statements. So good information or useful information will result in good decisions. And good decisions means good capital allocation. So this will foster the growth of our economy. And also there are two consequences of the decision making. So if the decision making does not turn out to be good capital allocation, we should modify the accounting. Yeah, there must be some issue in the accounting standards. We should update the accounting standards to improve the usefulness of decision making. And also, decision making resulting in the capital allocation finally will have impact on the economic activities. Okay, so the accounting, the role of accounting in our society is provide useful information, and also we receive feedback from the users, and to improve accounting finally will improve the information and improve the decision making. So this is like a continuing loops. Okay, that's the role of accounting in our world. The primary focus of financial accounting. Financial accounting is very common in our society. Look at this chart. Profit-oriented companies provide financial information to capital providers, and non-profit entities, including government, charitable organizations, and schools. They provide information, financial information to the donors, taxpayers, or the board of trustees, right? And also even household provide financial information. Remember, every year you will file your tax return, right? And also there are all type of users. But the primary focus of financial accounting is the profit-oriented company who file financial statements. And also the primary users of financial statement are investors, creditors, and other external users. So investors here we refers to the equity investors, okay, who provide capital to the profit-oriented companies in exchange for the ownership, okay? Yeah, the shares, the stock. Creditors, like banks, they provide loan to the company. The company can also issue corporate note, corporate bond to borrow money. And who invest in the corporate bond, corporate note will become the creditor of the company. Other external users, major external users, including mutual fund managers, financial analysts, stockbrokers, and rating agencies like Standard & Poor and Moody's, they also use financial statement to rate the risk of the business. These external users, they basically provide service to equity investors and creditors. Okay, so the two primary users are equity investors and creditors. Financial information is not all the information these users rely on. Okay, they rely on different type of information. Yeah, for example, remember during the COVID, Elon Musk announced he would accept Bitcoin as a payment for the Tesla's car from customers. Right after the announcement, the price of Bitcoin goes up. His followers also join in this run to purchase Bitcoins. This information just from the public social media can also be used for decision making, but financial information is a key component, okay? Is the most important information for decision making. Regarding the capital allocation, the company actually use financial information to analyze the company's performance and predict its future risk and the potential return. So as an investor or creditor, we basically focus on two things. One is the potential return, the other is the risk. These two are derived from financial information or financial statements. And the risk and return profile will have impact on their capital allocation decisions. In this class, when we refer to the financial statements, usually we refer to four primary financial statements. They are balance sheet, income statement, also called statement of operation. And we can also extend income statement to the statement of comprehensive income. Statement of cash flows, which tracks the cash inflows and outflows for different activities, and also statement of stockholders' equity. So these are four primary financial statements must be disclosed by the profit-oriented companies. But financial reporting includes more, not just for financial statement. It also includes other notes and peripheral information. I will show you an example regarding the real-world financial statement. If you type sec.gov in your browser, you will see this page. I type the ticker symbol of Google, GOOG or GOOGL. There's two different classes of stock. Then I can go to the page of Alphabet's filings. For the financial statements, we refers to the annual financial statement 10K and the quarterly financial statement 10Q. So you just hit this, you get the extension. Yeah, see, I've already checked the annual financial statement hyperlink. Okay, so here, if I click this link, you will be directed to the 10K form itself. Okay, I think it's over 100 pages, but to be more convenient to view the financial statement, yeah, let me click this little box, filing, and also interactive data, this blue bar. Yeah, you will see another format of 10K form, okay, and it includes the cover page. And we focus on the financial statement. There are about 7 items, yeah, but they represent different financial statements, but we focus on 4. The first one is a balance sheet. Look, this balance sheet report the company's assets. It includes current assets, total assets, liabilities. You can see current liabilities, total liabilities, and the stockholders' equity. Okay, so Google in its 10K report 2 years balance sheet. One is from prior year, one is current year, and that's for comparison. Okay, and the balance sheet report the financial position of company at a point of time. Okay, so these numbers just represents the financial position on December 31st, 2023. Yeah, one day before, one day after, the balance of these accounts may change. Okay, so balance sheet is like a snapshot of a company. Well, income statement, okay, it starts from the top line revenue for the past 3 years. Yeah, we can see its revenue grows to $307 billion. It subject all the expenditures. The bottom line is net income followed by the earnings per share. Okay, so that's income statement. So income statement report the company's performance during a period of time. For 10K, the period is 1 year. In other words, the revenue $307 billion is the revenue recognized during 2023, from January 1st to December 31st, 2023, and also the expenses incurred during this year. Income statement report the company's performance during a period of time. It is a flow, okay? Balance sheet report the stock. And the statement of cash flows here, there are 3 parts. One is operating cash flow. Okay, so we can see Google generate $101 billion cash from operating activities. Okay, and also investing activities, the net cash used in the investing activity is $27 billion. So Google spent $27 billion for their investment, for either financial investment and the non-financial investment during this year. Financing activity reports is the net cash used in financing activity is 72 negative. Yeah, why? Because it repurchased stock using cash, repayment of debt using cash, also it issued new debt $10 billion. Yeah, this total is 72 billions of dollars, and it is negative. It has net cash outflows. I will talk more about financial statement later, but here I just use the real world example to show you the format of different financial statements. The next one is stockholders' equity. Okay, it's quite big. Okay, yeah. So this one reports in the past 3 years, the changes in the equity accounts. Okay, it includes the change in the stock and the additional paid-in capital, the change in other comprehensive income, the change in the retained earnings. Let me scroll down to the current year. Yeah, the $283 billion, that's the total equity balance, right, at the end of 2023, is consistent with the number here in the balance sheet. It is $283 billion, right? Yeah, basically, statement of stockholders' equity track the changes in the equity, different equity accounts. Okay. In addition to the financial statement, you will also see other notes. Okay, these notes help financial statement users to learn more details of the numbers in the financial statements. Okay, yeah, financial statement, we say it is a summary, but notes provide more details. Yeah, whenever you want to learn a company's financial performance, Google its ticker symbol and search its financial filings on this webpage. Yeah, when we talk about the role of financial accounting, we refer to its role in the capital market. So let me introduce why capital market matters. Okay, so we know in our society we have different kind of economic resources, including human labor, natural resources like water, lumber, gold, or any type of resources can be used to produce goods or provide services. These economic resources are for economic activities. But we know if you have money, basically you can buy any economic resources you need, but at different prices. So basically, if you have money or capital, you have resources. That's why we say, capital allocation is equivalent to the resources allocation. So the role of financial accounting in the capital market is equivalent to its role in our economy. Because financial accounting provides information for the capital providers to allocate their capital or economic resources, right? So financial accounting have impact on the capital allocation. And in this class, we're talking about financial reporting by companies or corporations, right? So we're study from the perspective of companies or corporations. Yeah, so we refer to the corporations as the demand side of capital, while creditors and the investors are supply side of capitals. So for corporations, they acquire capital mainly from equity investors. These investors provide capital to the corporation in exchange for ownership interest, so a share of ownership. Creditors provide capital by borrowings, either through individual loans or publicly traded debt product. Okay, the company can issue debt securities in the capital market. Okay, so the investors can buy these securities, in exchange provide fund to the company. So I talked about the demand and supply side of capital, but why investors and the creditors provide capital? Yeah, the reason is because they want earn return, right? Yeah, the equity investors want to make money from stock market. Creditors want to earn interest return from the loan, or debt investors want to earn interest from the debt securities. These investors, when they make investing decision, they want to learn what's the expected return from these investing activities, and what's the uncertainty or the risks. And these two are two key inputs of financial investments. How to learn these two metrics? Yeah, you know the answer, right? From the financial statement. Because financial statement can provide useful information regarding these two key variables. Here, let me briefly introduce the rate of return example. Okay, and here we use the equity investor as an example. Okay, the investor invests $10,000 cash, purchase the stock, and next year the investor receive $400 dividend from the company, and also the stock price or the investment grows to 10,600 because of the stock price appreciation. So the total return is 400 dividend, cash dividend, plus the $600 price appreciation. So the return will be 10%. Yeah, we use amount of return divided by the initial investment, $10,000. So that's expected rate of return. Since it is return starts from the end of 2023 to the end of 2024, so this 10% return is annual return. But for investors, they also want to learn what's the future rate of return, right? So whether the company can still pay the dividend, same amount, or the company will increase the dividend or cut the dividend, and whether the stock price will goes up. The stock price, move according to the company's financial performance, right? So no matter the dividend growth and stock price come from the analysis of financial statements. Yeah, so we use this example to emphasize the importance of financial information. There's another example here. The initial investment for the stock is $200,000. Receive 4 quarterly dividend. Each quarter the dividend is $1,000. So 4 quarters, $4,000. Yeah, that's return from cash dividends. The price of stock increased 6,000, right? From 200,000. So the total return will be 4,000 dividend plus 6,000 stock price appreciation. So that total $10,000. Rate of return is calculated. Yeah, so the answer is 5%. We use the total return during 1 year divided by the initial investment. Another key variable is the uncertainty. And we know when you invest in the stock market, you may lose money because the stock price does not always grow, right? It may goes down or went to zero, possibly. The customer may default their loan, so the bank will not collect the principal. These are all potential loss for investment. Actually, for any investment, there's always uncertainty. The difference is the degree of uncertainty. Okay? But there are some special investment we consider it as risk-free or zero uncertainty. That's the security issued by U.S. government. Okay? Yeah, for example, if you invest $10,000, return is 5%. This investment is insured by the U.S. government. That means your principal and your interest are guaranteed. So this 5% rate of return is considered as free risk return. Okay. Instead, if you are invest in a profit-oriented company, there's a lot of uncertainty, right? So the investor will face risks because most investors are risk averse or they hate risks. To encourage investors to invest in the risky investments, you must compensate the investors for the risk they bear. So that's the trade-off of risk and return. A higher return, higher risk, higher return. If there's a greater uncertainty, the investors will expect higher return. To learn about the uncertainty and risks, we should also analyze the financial statement. In other words, the financial statement communicate the risk of the business. The primary objective of financial accounting is to provide useful information for investors and creditors to make investment decisions. And this useful information help investors and creditors to forecast the firm's future cash flows. The financial statement I showed you in the prior slides, using Google as an example, report the historical information. The balance sheet report the financial position in the past. Income statements, statement cash flow are all regarding the firm's prior performance. The company does not provide the future cash flows. The future cash flow can only be estimated, okay? So how to estimate the future cash flow? That's the objective of financial accounting. Provide useful information to estimate future cash flows instead of providing the information about future cash flows. For the future cash flow, the investors and creditors are interested in these three characteristics of cash flows. One is amount, timing, when, and the risk, uncertainty. So here we emphasize the cash flows. But what information is considered to be useful to forecast future cash flows? Next, I'm going to introduce the difference between cash and accrual accounting.